Welcome back to another episode of the Educated Homebuyer Live. This is where Josh and I answer your mortgage and real estate questions right here by questions that you submit, as well as update you on everything that's happening in the economy. So this past week looked a lot like last week in the sense that we got confirmation that the economy is slowing. And some of the biggest news coming out this week is the fact that inflation has moderated. With Josh, we want to throw that up there. Let's see here with headline inflation coming in flat, sitting at 3.2%. And then core month over month at 0.2%, bringing core year over year down to 4%. So with that said, Josh, I know this is kind of the report that we've been waiting on. With that, we saw the 10-year retrace even more, but now we're starting to see some consolidation, which is to be expected. And with that, rates are kind of hanging on. I know we're going to talk about rates. We're going to talk about some other things, but welcome to the show. Can you hear me?
Well, I'm just happy to be here after a nice little bout with a cold and a sinus infection. So hopefully my voice isn't any more annoying than usual, Jeb.
Well, we won't go there this evening, but we hope to, get through the show without any pauses, without any lags on the information. But as you can see here, we're looking at CPI, but we want to go back and just kind of start where we always do, Josh, and start with some charts. Or do you want to add anything else to the show before we get in there?
No, let's just go through the charts. I mean, we can kind of go a little deeper on the CPI, PPI, retail sales stuff that we saw today. But yeah, start from the top.
All right, let's start from the top as we always do and take a look at inventory. So inventory, everything always comes back to supply and demand, right? So at the moment, supply nationwide only increased 59 homes week over week. So leads us to believe that we're probably towards the peak in inventory and likely going to start some retracing as we move into the holiday season with Thanksgiving and Christmas right around the corner, which means lowest level of inventory likely hit sometime around New Year. This year's probably no exception, especially since we're starting to see a little bit of moderation in interest rates. But with that said, 59 homes week over week, sitting at 566,000. 541, 941, can't read that exactly. But as you can see, going back, we're right at that peak. In fact, if we go back and look at that previous chart, Josh, we're still sitting below where we were in 2022. So the question is, are we going to pass numbers in 2022, or are we going to moderate, at a level where we stay under those 2022 levels?
Everything is anecdotal, but what I can say, Jeb, is we did really hit a period, 3 to 4 weeks, when rates spiked and got in and around and above that 8% range, that most people, even the ones that had qualified, were just kind of like, we're going to see what's happening here. As they've come down, definitely phones ringing more. Have a couple of clients that put properties under contract this week. So with the lag there definitely can be a little backup. You know what I'm saying? If you have a 3-4 week period where no one's doing anything, even if they come back in the market, I wouldn't be shocked to see it inch up a little bit. Not a spike, but a little inch up. But that's just anecdotal from what I'm seeing.
There you go. So next thing, well, when you got a frozen mouse here, Josh, hard to do anything. But this is, new listings. So we actually saw a little bit of a pop in new listings. So we got new listings coming to the market. So you're asking, well, I thought you said only 59 properties came to the market. Well, what happened is we saw some new listings come to the market, but we also saw some properties go pending at the same time, which is keeping that number from really growing. But with that said, inventory is likely going to continue that decline. Weekly inventory change, we went from 566,882 to 566,941. Our peak is that 566,941. Last year, we went from 575,798 to 572,347. So we're pretty close to where we were last year at this rate. But for context, back in 2015, 1,135,000 homes were on the market. So considerably less than where we are today. This shows you weekly new contracts pending. So you can kind of see there, we saw that little spike in pendings, which we just talked about as new listings came to the market. Is it because of rates coming down? Maybe a little bit, right? We saw rates, Josh, the highs sitting around 8%. I know we're going to look at rates a little bit, further in the charts here, but where are we sitting today? If somebody were at 8% 2 weeks ago, what is somebody looking at today? Same same type of borrower?
Close to 0.75% better. And
Yeah.
some of that is the market improving, Jeb, and then some of that is lenders getting more aggressive and sharpening the pencil. I think if we pulled up the chart of the spreads between 10-year and mortgage rates, they're a little tighter. Not a lot, but a little tighter than they were.
All right. And this shows weekly new listings versus immediate sales. So we got 66,000 new listings and 11,000 immediate sales during that same period of time. So there you go. So why is only 59 homes or so being added to the market? That's because other homes went under contract during that same period of time that weren't new listings. So I know there's a lot of information here, but the easy answer is inventory is likely going to continue, moving sideways, if not down a little bit as we head into the end of the year. And then this just shows price drops, right? Everybody wants to talk about price drops. In fact, the recent video that I did, Redfin basically came out and say price drops are more or less at an all-time high. Well, you can see that's clearly not the case, right? Last year, we were at somewhere around 43% of listings having some sort of price drop. This year, we're sitting around 39%. This is a similar chart showing you the exact same thing. But just kind of an idea, I like to look at this, Josh, and see some seasonality in this, right? This is about the time of year where, price cuts do hit a peak and then they start to come down. So it'll be interesting to see over the next couple of months if we see that same seasonality with price cuts coming down as we trend into the beginning of the year. And then lastly, Josh, 10-year treasury. This isn't interest rates don't necessarily follow the 10-year, but it's, like you said, it's like a dog on a leash, right? You can't get too far from this. And with that, we've actually saw a little bit of retracement.
It's a dog on a leash, and the 10-year is definitely the master. The mortgages are just going to always kind of follow there. And the funny thing is, Jeb, when they change this chart and they put that thick line, you can't even see the downtrend. Like,
someone have to tell you a little bit.
Someone have to tell you that that's a little downtick there on that. Just again, following up on some data here, the Chicago Fed does a national activity index. We've been hovering there below what they see as recessionary, as that red dotted line there. So just another piece of data trending in that direction. Wanted to show this one, Jeb. This is a consumer composite index and a CEO confidence composite study. I don't have the website up, but we had, I think it was just in the last few days, we had consumer expectations of inflation and also just consumer sentiment going forward. And both of them were a little bit stronger than what I would expect. Their expectations of inflation and their expectations of the economy a little bit higher than what we thought. So what I thought would be important here, there's also a study that they do asking CEOs what they think. CEOs there are much more negative on the economy. And people usually say, hey, these CEOs are just pessimistic. They're looking out for problems. But historically, if you look here on the bottom chart, what we're seeing where those dates are, the CEOs were pretty correct on recession calls. So we're seeing more and more data. One of the people that we pay attention to, not that she's God, but Danielle DiMartino Booth, she said she believes that October will end up being when they do call a recession and date when it started, that October 23 is when she believes we'll see it. So more people lining up on that side of it. Jeb, I thought this chart, it popped up in one of my newsletters today, and I thought this was interesting. Wanted to draw the red arrow trend lines there. So M2 is the supply of money. And everyone was saying at the beginning of COVID, hey, we're going to have massive problems with inflation. You can't print this much money and not have issues. But we didn't, because you see the blue line there was velocity of money. So a lot of money was out in the economy, but it wasn't moving around because everyone was tied up at home, couldn't travel, couldn't go out to eat, couldn't spend money other than Amazon delivering stuff to your door. Well, what we saw is velocity, that downtrend line there, Jeb, says going back to 2008, we've seen the velocity of money decreasing. And that trend will come back into play going forward. We are almost back to where we should have been, but with M2 decreasing, it tells us there's going to be less economic activity going forward, should be less inflationary, and should be negative for GDP. So that's not all a good thing, but some of these things are pretty understandable when you start looking at the charts. This one, Jeb, the top one there, we show what is the estimated annualized U.S. debt payments, and you can see that line going straight up. The bottom one is the average credit card interest rate in the U.S. So we've shown the chart that credit card debt is at all-time highs, but most importantly, March of last year, 14.56% was the average credit card rate. Now we are up over 20%. That's a pretty hefty number. I talked to some borrowers today. They had $16,000 on a credit card, and it was over 20%. You're looking at that's $300 just to credit card interest. Where as recently as 5-6 years ago, you maybe had an 11 or 12% rate on that. So just big picture, carrying that credit card debt is something that you never want to do, but you definitely don't want to do it with where rates are. I don't know if you saw this one pop up, Jeb, but we get the questions here every week. You guys are like, who's buying? How are these people buying? Well, repeat buyers are average age 58. They've built up a bunch of equity. They've been through this. Many of them are maybe not downsizing in size of home, but going to a cheaper region where they're just paying cash. They're not impacted by interest rates. And even first-time buyers have trended higher from 30 to about 33, 34. Now, we already went through this. Did you have anything else to add on this one, Jeb?
No, not really. I mean, I don't know if we have the chart in here showing, expectations for next month. Did we put that in or no?
No.
Just kind of that bar graph that, the next couple of months, I think you have, I don't want to pull up another browser because it'll just screw everything up. But this month, basically, I think we dropped off like a 0.5 and we added a 0, right? So that's why inflation fell so much. I mean, you went from 3.7 to 3.2. Next month, you're probably not going to see, I think you either have a 0.2 or a 0.3 that's going to come off. And there's a really good likelihood that you see, somewhere between a 0.1 and a 0.2 back on there. So, it's going to take some time to get back to a 2% number unless you can continue to see these month over month flat numbers, which in all reality, I don't think that's reasonable to think, but I don't know what the expectations are at this month but going forward, but that was a big drop, it's in the headline.
And it's reasonable to expect over the next couple months, like you said, the base year effect is not going to be strongly in our favor. So we have a soft number falling off, probably replaced by a soft number, but very similar. So in the way those are calculated, probably not going to be much movement. When we get into Q1 of next year, that's where we'll see it. You guys probably don't follow nearly as closely, but PPI, producer price figures, came out. They were even softer than this, and those will generally lead CPI by 2 to 3 months. Could tell us more softness in Q1 of next year. What we got today that kind of gave back some of the gains, you'll see in the chart here on the 10-year, retail sales. Retail sales beat expectations. They were negative 0.1% instead of negative 0.3%.
Yeah, it wasn't a good number by any means. It was better than what they expected. Therefore, the market reacted accordingly. But with that said, Josh, CME, so this is kind of the Fed watch, right? What they're expecting to do. So at the moment, 97.3% chance at the December meeting, they do absolutely nothing. Keep rates where they are. Same thing, January, 96.4%. And then in March, you start to see a little bit of a change, right? 73.9% says they keep it where it is. And then there's 24% of people at the moment thinking that's where price cuts start. I don't think that's, going to happen quite yet. But if the data continues to get worse, then we could see that. But in May is where you start to see, 40% of people thinking, rates are going to stay the same, 47% thinking there's a price cut, and even 11% thinking that we drop it, that we're already down, 0.25% and dropping another quarter at that time. So, Josh, I know you kind of like the chart at the bottom, so why don't we explain that?
Yeah, it just breaks it down. The one at the top can get a little messy. You're looking like, well, what am I seeing? All these different probabilities for different rates. The one at the bottom just says after March of next year, the market currently, today, we don't know what it's going to think in January or February, but today, the futures market sees rate cuts, a greater likelihood of rate cuts than hikes from May forward of next year. And right now, if we look at it, it's a different chart, but projecting a % of rate cuts throughout 2020 calendar year 2024. So down to about 4.25. We'll see how it plays out. I don't like the way the cards are unfolding at this point, but we'll have a much better handle in January. Jeb, people have been asking you, hey, where do you think the things are going to end this year in terms of rates, in terms of this, in terms of that? I think that 2023 is basically done. There's not a lot of big market moving data the next couple of weeks. That puts us into the beginning of December. No matter what happens, I don't think we're going to see any earth-shaking data in December. But when we start seeing retail sales in January, if you have a weak holiday selling season, you can see some pretty big revisions, and this chart could change a lot. Not saying it will, but it certainly could. This just wanted to show you guys, started liking to show this chart. It's a 5-day chart. What happened on the 10-year treasury just in the last week? So it inched up higher Thursday, Friday, Saturday, or Thursday, Friday, Monday. Then we had CPI yesterday, Tuesday, big drop. Basically trended sideways for the rest of the day. That retail sales beat, which is crazy. It's just the market was expecting -0.3 and -0.1 was better than they expected. And we gave back about half of that CPI gain. So sitting at about 454, we were about 445 yesterday. This is zoomed out. Jeb, you and I looked at this yesterday. This is a 5-year chart on that. That is a defined uptrend, a very defined uptrend in 10-year treasury yields. So despite the fact that we have our cute little tiny green arrow up here to the right, we haven't really seen any major trend change. Even if we draw it back here to just middle of last year, that is a solid uptrend. We need a lot more movement before we can say that this is not a bearish market. So for those of you that are in the market, you have properties under contract that are going to close in the next month, 3 months. You have something under contract with a builder that's going to close in the spring. If you see weakness, and if we give up any of the gains or much of the gains we've had here recently, you probably want to be quick to pull the trigger. I'm hopeful here. Jeb is hopeful that rates will continue to trend better, but you got to keep your finger on the trigger in case that isn't the case. This is just to give you some context. Mortgage News Daily, as of yesterday, was reporting 7.45 on a 30-year fix, 6.77 on an FHA, 6.75 or 6.78 on a VA. Pretty darn close for well-qualified borrowers. You can probably do a little bit better out there, but it's not going to be significantly different than that.
All right, good stuff, Josh. So a moment ago, you said you don't like the way things are playing out. What did you mean by that?
Almost all of the data is worsening and worsening fairly quickly. All of the things that are forward-looking indicators are getting worse. And in general, for us in the mortgage industry, when you sit here and say 90% of refis are gone, the only refinances that are left are need-driven cash out or divorce, death-based stuff, and purchases are down. What's the number, Jeff? 50%? You're saying basically 65% of all loans are gone. If rates were to drop 1%, doesn't get back all 65% of the drop, might get us back 10%, 20%, 30%. So we find ourselves saying, well, that's going to be good for rates. That's going to be good for rates. But when you step back, bigger picture, what it means for the economy, they're not good things. So I think it's going to be more positive for us in the mortgage and real estate industry, less positive for the economy as a whole. The good thing from that perspective is, Jeb, most people who own homes or are wanting to buy homes are on the upper end of the scale and are more insulated from the problems that are likely to occur in terms of credit card debt, all of that stuff, lack of savings, increased unemployment rate as some people get laid off. And I don't think we're going back to double-digit inflation, but if you go from 4.1% to 6%, we got 50% more unemployed people, and that's going to be trouble and unhappiness and unpleasant for their family. So big picture, I don't like what it says for where the economy is headed. For us, it's probably a slight positive.
No, got it. Yeah, no, good explanation there. And yeah, we don't want to see people lose their jobs and the economy get worse by any means. But I mean, unfortunately, the data is kind of supporting that at the moment. So, and with that, we've talked about bad news in the economy typically means good news for those with interest rates. So we will see. But with that, Josh, 18, 19 minutes, that's pretty quick for us to get through that. If you find any value in that at all, do us a favor, hit the thumbs up if you haven't done so already. And if you haven't subscribed to the channel, that would mean the world to me. If you do that, I greatly appreciate all the support. And Josh, this past week, we talked about multifamily FHA putting 5% down, 3.5% down on the Educated Homebuyer podcast. So we did episodes like this because there's a lot of information out there right now kind of trending with buying multifamily with small down payments. We kind of took it, provided some reality to that information. So if you haven't listened to it already, you're not following the Educated Homebuyer, go check it out. Subscribe to the channel, follow the content. And it's also on Spotify and YouTube if you like that information as well. So That said, Josh, we're now answering some questions. So if you have questions about the market, do us a favor, put them in the chat, and we'll do our best to get to them in the remaining 40 minutes of the show, Josh. So this is the last question that's come in, but it's a question that kind of goes along with what we were just talking about. So I'm going to throw it up here. Flash a light. Stagflation, is it in the cards for 24 or 25? So we've talked, Josh, multiple times. We've really only had stagflation one time, really in history that I recall, which was back in the 70s. I can't even recall it. I wasn't around, but back in the 70s. So maybe talk about what stagflation is and why at the moment it looks like, things are trending towards an economy where we wouldn't have that.
It's a stagnant economy combined with high rates of inflation. So I don't think we're going to have no growth. Technically, the definition historically for a recession has been 2 consecutive quarters of negative GDP growth. We had that in early 2022, and the NBER failed to call that a recession. They added some additional verbiage there to what makes something a recession. So do I see a recession in 2024? I see no guarantee of it, but a high probability of it. Is that 90%? No, but 50, 60, 70% chance. So there you have the stagnant economy to a decreasing economy. And do we have inflation? Again, you can kind of reverse engineer the numbers. The wild card that has always worried me, Jeb, is energy costs. We saw that 2 months back in the CPI figures that oil and gas had popped up for a month, and we had a little bit hotter figures there than we had previously. And then last month, it was kind of a tailwind for us in that energy prices were down. As long as energy prices remain contained, we can look at the other things that go into CPI and they should continue moderating. But the long-term goal is 2%. It's where the Fed wants to see it. We just showed that we're at 4%. So we've got a long ways to go. We have inflation. It's way better than it was a year ago, nowhere near where anyone wants it to be. And we are heading into economic headwinds. So do we see stagflation where we see a giant recession with 12% inflation like we had in the early 80s, or 9% inflation, whatever the number was that they hit? No, we're not going to see anything remotely close to that, but it's all relative coming from what we've seen over the last 10, 15, 20 years. If we had just inflation staying at the current levels, Jeb, and a recession, it would be unpleasant. It would be more unpleasant than what we've seen. You don't want to say that we've seen it all, because that 2008 recession, they didn't call it the Great Recession for nothing. We didn't have inflation, but we had a really, really bad economy at that time.
All right, good stuff. So Daff was one of the first comments that came in. Says, I'm in Long Beach. I want to sell, but don't want to deal with buyers and all the back and forth. Any suggestion on how to approach selling? Work with a professional to start with. Would love the opportunity to help. You can go with that link below. But basically, the job of an agent at this point would be making sure that the buyers that come into contract, that are making offers, that are looking at your home, are qualified, right? That they're doing their job to make sure that it's not somebody that's going to back out because of financing issues or something else falling apart that's uncontrollable. Now, you can't control emotions in the process, but, having professionals on both sides of the transaction limit that sort of thing. I would say, in my experience, I rarely have deals fall out of escrow. But that's just, knowing that you got a solid buyer and a solid seller on both sides. So that's the best advice I have. My contact information is trending there across the bottom, scrolling rather. If you want to get in touch, would love the opportunity to help. Josh,
trying to claim that your contact info is trending online.
Trending. Joyce,
bro.
What are your thoughts on using a real estate attorney when buying a house? I'm in the DC area using the movement lender for a VA loan. So 2 different questions here. So some states, so real estate attorneys in some states, right? Maybe all states have the ability to get a license to sell real estate fairly easily after having a law degree, especially here in California. You become a broker pretty easily just by taking the test after you've done everything. But nevertheless, I don't really have any advice on that in your area unless that real estate attorney does real estate all the time outside of the legal aspect, deals with, the process of inspections and everything that goes along with it. I would probably still move towards going with a real estate agent, a professional in the business that does this full time. Would you go to me to ask legal advice? No, I mean, I might know some legal advice and I might be able to guide you when it comes to real estate to some degree, but you would hire an attorney. I think the opposite is true. If you have an attorney, hire a real estate agent and do that side. My advice there. But Josh, Movement Mortgage, I'm assuming is who they're talking about there for a VA loan. In any advice there?
Absolutely. And this is a good one because I want to go over two things we talk about. Movement is not known for having good terms, especially on government loans. So I would absolutely recommend just check with the broker, compare and contrast one loan estimate directly to another. Now, do I recommend that if the broker comes in and says we're lower, that we go with the lowest bidder? Absolutely not. Expertise matters. Knowledge matters. What Jeb talked about matters. It sounds like thus far into the process, you're comfortable with the person that you're working with at Movement. Doesn't mean that they're great. Doesn't mean that they're awesome. It means that at least you're comfortable with them and you have a rapport. But validate and check the numbers. If you haven't checked with anyone else, you have no point of reference. If you check with at least one other, it's unlikely that you found two high-priced lenders. You at least know that they're both in the range of what should be acceptable. And then you can make the decision on who do I have a rapport with, who has the knowledge and expertise that I need and is going to look out for my best interest. They're both equally important. You want to make sure you get good terms, but you want to make sure you're working with a pro.
And that kind of goes along with your second question, Joyce, asking if there's a way to double check to ensure everything has gone ethically well. The ethics side of it is hard to detect, right? Because they don't know everything that's happened in the transaction, but they can go over the numbers. They can look at, hey, what are you being charged, what the rate is, and get a comparison. And you should be doing that before you ever pull the trigger to go with a lender. I mean, you should be getting comparisons before you sign on the dotted line, so to speak, and kind of get a couple people. But even with that said, you can be in the middle of a process, something not going right, switch lenders if you have to, and go a different direction. So there is options out there, but it doesn't hurt to have another conversation just to make sure what you're getting is accurate. Red Apples Kim says, I would like to buy by March of 2024. Can you give some insight on what not to rush into when looking for a property in Orange County? I would say, no different than any other market, right? I mean, you don't, people buy emotionally, justify logically, right? It happens with everything, not just housing. It happens with cars. It happens with almost every purchase. It's an emotional purchase to some degree when there's money involved, especially when there's a lot of money involved. So try to think of it from a logic perspective. Again, long-term time horizon. Do you have that? Are you comfortable with the payment? Do you have money in the bank? Is this a house you can see yourself in for that period of time? Is it going to meet your needs for an extended period of time? Those are the things I would be thinking about. Because again, we've discussed it before. There's an opportunity that you don't see a lot of growth in home prices over the next couple of years, more sideways movement than anything else. And so you just need to be comfortable in that position. But nothing, I don't think specifically to look for. I always say, think of it when you buy a house from the perspective of being able to sell it down the road. And what I mean by that is, think about location. Is it easily sellable later on? Does it back to a freeway? Does it back to a major street? Are you going to lose buyers in putting it on the market for potentially things that a buyer wouldn't want in a property? Always think about that stuff up front. Think about, selling it down the road and how that might affect your purchase now, right? Because I think that helps with the emotional side. But that's the only advice I got. Josh, I'm going to throw one to you because you're an emotional guy. Buyer's remorse is a thing during the first few years of ownership. After so many years of ownership, does buyer's remorse go away?
Well, here, rather than relying on just my experience, you have a lot of buyers and you are in communication with them in the weeks and months after closing. Do you take the premise that he's starting from? Buyer's remorse is a thing. Mm-hmm. How many buyers do you have that have buyer's remorse? I see these headlines and these crazy stories that 73% of millennial buyers have regrets over buying a home.
Right. I think it's one of those things you only know if somebody tells you they have buyer's remorse. So you're not going to know in most cases. I will say, in all of the real estate that I've ever sold, I've only had one person buy a home and had some sort of remorse to the point that they sold that home within weeks after buying that home. Everything else, people have owned the home for an extended period of time. I've never had, I'm talking about years, at least a year and a half. 2 years, that sort of thing. I had one client, he was coming from Texas, bought a house in Westminster, and him and his wife were moving here, and he bought it and closed on it. And within a couple of weeks, he never saw the property in person, by the way, all via Zoom or FaceTime or whatever, and tried to do the best to explain to him what he was buying. Didn't necessarily think it was the best purchase, but he wanted to move forward with it. He ended up selling it. And it didn't use me either, by the way, but gave me a good review online. I have no idea what happened there, but I don't think it's as common, right? I talk about it all the time. Buying anything that is expensive, you have some sort of remorse, right? And it's not a remorse in the sense that it's necessarily a bad thing. It's kind of like a cold, like it's just one of those things. You question it. I get it when I buy things that are a couple $100. Sometimes I buy it, and then afterward I'm like, should I have bought that? Did I really need it? That sort of thing. Then a couple of days, hours, maybe it's gone. So home purchase, a lot more money, down payment that you've worked for, maybe you're going from a rent payment to a mortgage payment. It's more expensive. There's going to be some of that, but I'll tell you, long term, you're going to look back and be happy that you did it, right? I mean, I will tell, most people that I talk to that have owned real estate, their biggest regret in real estate isn't buying the real estate, it's selling it along the way, right? That's the regret. That's the remorse part of things when you talk to somebody that has owned real estate long term.
I think you're onto something there, Jeff. People that get in and out quickly, a lot of headaches, a lot of hassles, a lot of transaction costs, loan costs, selling fees, realtor fees, escrow, title appraisals, all that fun stuff. Over time, when you've paid the mortgage down, the house is appreciated, and you sell and you get a big check, it covers a lot of that. I'm just being halfway facetious there, but it is real. Over time, the economic benefits start to outweigh the whatever little amount of remorse you may have had on the front end. I don't know. For me personally, I'm pretty deliberate. I don't go into things that I'm not comfortable with doing. So I've never one time had buyer's remorse. Doesn't mean you're not a little bit scared on the way in when you're doing something new and different and at a much higher price point.
I'm equating that to buyers. I'm like, I'm equating that emotional thing that you're scared to some sort of, not remorse, but just like it's part of that process. So
yeah,
that's what I mean by that. Yeah.
Yeah.
But good explanation. All right. Orange Pulp says, do you think seller buy downs are hiding price drops? Home listed at 230, seller buys down rate from 8% to 5%. That would be like 12 points. That'd be like almost $25,000.
But before you answer, let's go all the way through that. So set it
seller
up,
buys down rate from 8% to 5%, costs seller 30 grand. Oh, there you go. However, the record says home sold for 230. So what are your thoughts there, Josh?
So a $30,000 seller credit on a $30,000 transaction. That's 12%. A 230. So it's a 12% seller concession. There's no loan program that allows it. So what I would file this under is be careful. I have no doubt that this is the way your friend told you that the transaction went down. There's no world that the transaction went that way. Every loan program has caps. FHA at 6%. Conventional, it varies depending on what the down payment is and the occupancy, anywhere from 2% up to the same. Actually, you can go 9% if you have a really big down payment on owner-occupied property. But nowhere can you go near 10, 12%. So did they pay some costs? Did they buy the rate down? Because the other thing, if you come to me with a contract and say, hey, my seller's willing to give me 30 grand, I want you to use that 30 grand to get me the lowest rate possible. There's a points and fees test, and every lender's compliance department has a different definition of what bona fide points are that are actually going to buy the yield down. It should be legal. It should be allowed. But the way that the points and fees test is written, most lenders will not allow you to do it. The way builders are doing it is they're just eating it. They're losing money in terms of closing that loan on the back end because they own the lender. They're not paying the lender. They're not paying that for you. Their wholly owned subsidiary is offering a lower rate. So it's happening on that side. And we went through the numbers a few weeks ago where they're eating like $30,000 of buy downs. Builders are on many of these. So it happens, but it cannot happen in resales. So just be careful when you're hearing these things. And what I would say, Jeb, before you answer it, I want your answer far more important than mine on this one. But we had Diana Olick on CNBC the other week, and she had this narrative that, hey, buyer or builders are buying rates down to 5.75 right now. That's masking this weakness that their prices have to drop. There is some truth there. Prices would come down if they weren't buying the rates down. People buy a payment above and beyond a price. So they're being able to put a cap on that payment by doing that. So there's something artificial in that. But if we are correct that rates trend down lower in the future and everyone can get that rate without the builder having to buy it down, then things kind of normalize. But it's very different between the builder market and new construction and resales because of the limits that are placed on it. And Jeb, you can go into detail on this. That is noted. It's noted on the contract. It's noted in the MLS, and appraisers are looking that up. They know if those concessions were there, and they are accounted for in the appraisal.
Yeah, I mean, like you said, is a concession, a credit helping home prices stay higher than they should? Yeah, in some cases that's absolutely the case. But like you said, Josh, I think what the consumer doesn't see is in the MLS in private remarks, we have to put in there, right? Why, if there are seller concessions, we're supposed to put in, hey, $30,000 rate buy down to buy the rate down in this case. And the appraiser looks at that and helps justify their next appraisal in that market using that comparable. So, can it happen? Sure. Is that the case across the board? I think the easy answer is no, right? I mean, it's easy to sell the headlines that is the case and that everyone's doing that. But I think most buy downs you see in most markets are, probably buying a rate down at most, maybe 1%. I mean, and even then that's 4 or 5% that's costing the seller. So when you're talking, a $250,000 purchase price, that's 10 grand that a seller is paying in order to do that. So that seller's really got to want to sell that property in order to take a loss at that. And, or maybe it's grossly overpriced to start with. And the seller is doing that to help, get their price versus doing a price cut, and who knows, right? There's a lot there to unpack. But I think the easy answer is partly true and maybe a little bit inflated in how it's portrayed out there in the market. Josh, if rates were to drop to 4%, how much higher would home prices increase now that there would be an influx of buyers?
It's kind of a magic number right there, 4%, because I think most everyone thinks 3% is never coming back. So like 4% in most people's minds is about as good as it gets. And it's literally half of where we peaked at. That would have a monstrous impact on the market. I don't expect it to happen anytime soon. Again, a little sneak peek on the podcast. We had Barry Habib in, and we went through this topic of how low could they go? What could we possibly see? And no one foresees anything along those lines. All three of us agree that rates are going lower. None of us agree that they're going anywhere near that. So it's a crazy question, and it's an extreme number because that would be absolute best case scenario anytime in the near term future. And what would come along with those really low rates would be a really bad economy. We talked earlier in the show that bad news for the economy is good news for interest rates. That would be a tidal wave of bad news. And generally when that happens, it takes some of the wind out of the sails of home buyers and sellers looking to buy. They're not quite as enthusiastic as what we just saw. Remember, we have recency bias, and we look back and go, everything was going pretty good in the last 2-3 years. Rates were really low. People are working from home, making a bunch of money, less commute costs. They're getting bonuses. They're getting all sorts of good things all happening at one time. To get 4% rates, we got some bad stuff happening at that.
Yeah. And understand that last time we had 3% rates, the economy was actually really strong, right? I mean, this time the economy is going to be weak, and therefore, and the government's not, pushing a bunch of, money into the economy. People aren't staying at home, saving money, doing all the things that help drive that boom in housing, right? So you got to factor that in. I mean, would it increase buyer demand? Sure, it absolutely would. But does that mean home prices are going to shoot up like crazy? I don't think so. In most markets, I think you're going to have a lack of supply to some extent. Because anybody putting their home on to sell it is probably buying something else. Therefore, you don't really have a net increase in real inventory. So difficult to say. Difficult to say.
There's a good follow-up here, Jeb.
Yep.
Fred wants to know, what was the interest rate before April of 2020? Before COVID, we were already in the low fours for the best borrowers, paying a little bit for in the high threes. So we were kind of what people consider to be as good as rates could possibly get. You had the 10-year treasury was already down in the 2% range. Inflation was really low. The Fed was worried about, how are we ever going to get inflation up to 2%? So very, very different times. But it is important to remember, we get really myopic and we have that recency bias that, hey, things have been this way for the last 12 months. So, oh my God, they're going to be that way forever. Or things have been trending up for 2 years. They're going to continue trending up into the future. We don't know, but you want to look and read the numbers. You want to know what numbers to look at and read what's coming down the pike. As we said earlier in the show, Jeb and I both believe that we're going to see some weakness in the economy. It's going to lead to lower rates, but it isn't like everything positive at once like we had during COVID.
Agreed. Another question on rates, Josh. And Curson says, I have the option to float down from 6.49 to 6%. I wanted to wait since all the trends are downwards. Should I wait a bit? I hear rates tend to drop around this time of year. My closing is December 7th. So that's 2-3 weeks away. With that, Josh, there's a follow-up question. How can you float down from 6.49 when rates are currently at 7.5? So couple of things going on there. And so, address it how you want.
Yeah, you have to be buying new construction, right? The builder is buying forward commitments and buying down that rate. They're eating a chunk of that cost. So it's just in how they're managing the rates and managing what they're willing to eat. So when you put that under contract and they gave you a rate and quoted you, it was X% below market. So what they're doing is just saying, hey, the market has come down. We will continue to give you that benefit below market. Now, in terms of what the market does between now and December 7th, we looked at the economic
Lock
calendar.
your loan.
Yeah. We looked at the economic calendar here today. Next week's Thanksgiving. There's nothing between here and Thanksgiving. The following week also really light on economic news. So generally, when we've seen a nice move from damn near 5% on the 10-year down to 4.54, we need some more really good positive news to push it lower. It doesn't just magically keep going in that direction. And there's nothing on the calendar that can come out scheduled over the next 2 weeks to push it lower.
Well, the reality is, Josh, is you were willing to accept the 6.49. God just gave you a 0.5% lower. Like, take the 5%, the 0.5% lower, and lock your loan. Like, you were happy at 6.5. Now you get 6. Dude, take it and move on. Like, no questions asked. Thank you. Next. Like, when can I close? Can I close tomorrow? Like, let's get this done. With that said, Josh, to answer this question, so they're asking, how can you even get a 6.49 when rates are at 7.5? So you kind of addressed it in the question, but I understood it, but for somebody that doesn't understand what you're talking about forward commitments, what does that mean?
The builder's lender is losing money on that loan. So they said, we're going to lose this much. If the markets come down, we'll still lose that much. They're not going, whew, good for us. We don't have to lose money on it. A builder's lender functions very differently. They're not out there trying to find people who want loans to go buy very different houses who may or may not close at different times. They know they have X number of homes coming on the market that are going to close in this window, and their buyer looks like this. 80% of them are going to be conventional loans. So they can go into the market and say, hey, in December of 2023, we are going to deliver 200 $500,000 loans. Did I make that too hard on myself, Jeb? That's $100 million of loans. So if you're an investor, would you offer someone a really smoking deal if they were going to bring you $100 million of loans in 30 days in a market where most companies are not producing anywhere near that? Yeah, you will. So they're getting the best of all possible terms by bringing a homogenous pool of loans to the market and putting them all out for bid at one time. And with that, they're getting the best pricing, but they're still losing a bunch of money on them because they're making so much money on the home they can afford to.
Good stuff. So this is a two-part, well, not a two-part question, but there's goes a little bit more into it after this. So Chris says, hey guys, love the show. Trying to figure out if I want to rent out or sell my home, my paid in full home. My home is on the market in Phoenix. After 50 days, 14 showings, and 1 cancel, it's looking rough. And then he goes on to say, I'm selling for $475, but if I rent, the income is $2,000 a month. That this doesn't offset a $6,100 new mortgage payment. Should I rent for a year and hope the buyers come back and rates go down? So I'm assuming it's got another house where the mortgage is $6,100 because this home is paid off. So Josh, what is your advice to someone in this market? Do you take the loss and sell it? I mean, I think you so at $4,100 a month loss, so to speak. I mean, I guess you can't really look at that as a loss because
It's the cost of shelter.
It's the cost of shelter, exactly. But if you're basing it off your new mortgage payment, you're losing $4,100 a month. If you want to look at it like that, times 12 months, roughly $50,000. So at $475, are you priced correctly in your market, or are you $50,000 overpriced? I mean, if you're willing to do that for a year and your plan is to sell it at that time, I would just say you continue to reduce now and see if you get an offer at 425 or whatever your number is, get out and move on. And that way you free up $400,000 in cash and you can go on. I mean, that's a big number that you're quote unquote upside down if you're not comfortable with that loss and or if you need that cash. What are your thoughts, Josh?
He followed up, Jeb, said he'd likely need to reduce another 30 to 50 to sell. So you did the numbers. You're going to come out of pocket over the next year $50,000, whether you like it or not. So if your intent is to sell, I think Jeb nailed the math. There's 4 or 5 different ways we could run the numbers on this, but I think the numbers that Jeb did are the way that I would look at it. One of the things that was going through my head, $2,000 a month, it's $24,000 a year. If there were no expenses, no vacancies, no upkeep, no nothing. So 24,000 off of basically a $500,000 asset that yields less than 5%. You can get 5% in the CD right now. So you take the money, throw it in the bank, pay the other mortgage down. Any number of things are going to put you ahead financially in the short run. So if your intent is not to own it 10 years from now, when I think it's safe to say it's going to be worth more than it is today, and it's already free and clear, you can't pay it down. It's putting money in your pocket, but not to the extent that you're paying money out on the mortgage. So again, we could spin it a couple different ways, but Jeb nailed it with the.
Well, your other option, and this is something you consider, is doing some sort of lease option. I mean, you own it free and clear. Can you get somebody to give you a down payment, lease it back at a decent? I mean, there's some other creative things that you could potentially do if you don't need that cash up front, or could take a portion of it and somebody could get seller financing from you to help offset it. There's some things there. But again, that's a different conversation for a different day. Hopefully that was helpful to you though. Josh, we got a couple of questions. I mean, this one's a pretty easy one for you. Are there any certain conditions that have to be met to refinance a conventional loan?
So with conventional loans, they're full qualifying. With FHA, VA, USDA, they're streamlined refinances, which basically you show you have good credit, you've made your payments on time, and the government is guaranteeing those loans. So they say, if we're going to guarantee you at 7% and you make your payments on time, we will guarantee you at 6%, at 5%, at 4%. Conventional loans have a quasi-government, an implied government guarantee. It's not a true government guarantee. So they don't really have a streamlined refinance program. What that means is you have to income qualify. The property has to appraise. The credit scores have to maintain within their guidelines. With an FHA or a VA, the guidelines don't say you have to have a minimum credit score. The investors who are buying the loans and making the loans that you would go to do have overlays restricting that. But the biggest one is you have to have income to qualify. And then the other big one is the property has to appraise and support the value.
Good stuff. Wesley coming in, just asking how we're doing. Josh, how are you doing?
I could be better. I could be better. Yeah. Not feeling the best, Wesley. I'm a little under the weather.
You know, I could be doing better as well, but I have a lot to be grateful for. Therefore, things are good. Things could always be worse, right? So focus on the positive and focus on the controllables. That's what we talk about here. Even Fred comes in and says, even after buying my house this April, still like listening to y'all content. y'all's content.
I like it. I'm happy that
We
we
appreciate it.
because we had just imagined once people got their houses, they're like, peace out, fellas. We'll catch you in 5 years, 10
That's
years.
what Lego did. Lego used us, and then she's out.
Yeah.
She's out.
Yeah.
Jeff Lou has a question. Lou, is household income much higher compared to circa 1980, assuming that there's more multi-generational dual income family these days? So why is affordability considered lower now? Right. So the title of this episode was Housing Market Affordability is at a 39-year low and getting worse. So that came off an article basically coming out of a couple of things that were ran. National Association of Realtors ran a study. I think the average income needed right now to buy a house is, or the median income is like 110,000 or something, which is, I think $18,000. I can't remember the exact numbers, but higher than what it was last time the study was done. Anyway, there's a link in the description for the article. I don't remember. I've read so much stuff recently, I don't remember everything. But Josh, what are your thoughts on the question here? Because we've talked about this going back to 1980, in early 80, where affordability was actually worse, right? I mean, at that time in 82, it was worse than it is now. So that's why it's a 39-year low and not an all-time low, because affordability back in that time was lower because interest rates were higher. Even though prices were lower, it was more expensive based on where we were. Now,
and
what are your thoughts now?
The solution was easier then also because it was primarily wasn't driven by astronomically high house prices. It was driven by a tripling of interest rates, which didn't go back to where they were all that quickly, but they went to half of what they were fairly quickly. I went to my best friend Fred over here. Median household income in 1984, which is as far back as their chart goes, was 22,420. Household income and the most recent read is 74,580, so about 3x. But if I remember correctly, home prices are about 8x over that same timeline. So when we look at prior to the run up from say 2014, 2015 on, you could explain most of the increase in home prices with the increase in median incomes, and the primary change being dual income households, not multi-generational, but in the 70s, most moms never went to work. And in 2010, most moms go to work. In 1990, 2000, most moms went to work. So when you look at it, income prices to household income remain relatively stable, but we're still seeing a much bigger multiple than we've seen previously, which is why affordability is strained.
There you go. Good stuff. Patrick came on. This could be an option for you, Chris. Says, message 2 weeks ago, if home wasn't selling and on the fence whether to rent or sell. Buried a St. Joseph last weekend. Got 2 showings, 1 rental application, and an offer since. House is under contract. So I have a buddy of mine who's a real estate agent that buries one of those in the front yard every single time. Little St. Joseph thing. You can order them off Amazon. Buries it in the front yard and swears by it.
I thought you were going to say it's like this big, like 2 foot by 6 inches.
No,
Just a little guy.
Little guy. And does it. And I think you have to bury it like upside down. Like there's something to it. But anyway, maybe that's your option, Chris. Give it a try and come back to us. We want to know if it works. Maybe I start using it, But anyway, in all reality, congrats to you, Patrick, and good luck to you, Chris. Josh, we're 5:53 in. People have stopped with the questions. So I'm going to just kind of insert myself here and say, if you found any value tonight so far, do us a favor, hit the thumbs up. Subscribe to the channel. We're at what, 90? Well, I'm at 93,000 or so subs. Trying to hit 100,000 to get my kids a silver play button. And then I'm quitting. I'm done with YouTube once I hit 100,000. That's it. I'm out. Greener pastures ahead. No, in all reality, continue to do it, but that is a milestone for me and would love to hit it. And if you haven't gone over and checked out The Educated Homebuyer, I think we're sitting at like 2,300 subs on that channel, providing a lot of content, a lot of deep diving into topics. Josh, forgot his name, co-anchor on The Educated Homebuyer podcast. He kind of mentioned it earlier, but we did a 40-minute conversation with Barry Habib, who is basically, the guru when it comes to mortgage rates, predicting what's happening in that world. And really, really good episode, Josh. We tackle really big questions in there about affordability, about house prices, about the direction of rates, what all of that means. And he took it down to like layman terms and to the point where really anybody can understand it. He wasn't talking high level. It was talking in a way that average consumer can listen to it. So that's actually going to be out next Wednesday. I think probably one of our better episodes, if I'm being honest. What are your thoughts?
Is that because you and I only did 10% of the talking, Jeb?
I mean, perhaps, yes. I mean, somebody with actually authority came on and said
it was
something.
the insightful questions that we asked Barry. But seriously, Barry, 4 times out of the last 10 years has won the Zillow and Pulsenomics Award for best real estate and interest rate forecaster. But more importantly, he's been doing this for over 40 years. And basically, the big piece we went through is buy versus own and the cost of waiting. Those are big questions that we get here on the show. Should I buy now or should I wait? And what is the true math? How do we really do those numbers? You see some really horrific stuff on the internet about rent versus own, and he has a very cool calculator. Went through a very good example. So I liked that episode a lot.
And he even talks about being wrong, why he was wrong. So he's not coming out saying, hey, I've never made a mistake. I mean, he was wrong this year, but he tells you why he's wrong and kind of gives you a forecast going forward. So I think it's good stuff. So check it out next week when it drops. Josh, are buyer's agents here to stay, Josh, or do they go bye-bye? So if you haven't been living under a rock for the last 2 weeks, you've probably seen a headline to some extent that their big case happened where they essentially awarded $1.8 billion or something crazy to homeowners for basically buyers agents coercing or the National Association of Realtors coercing sellers into paying buyers agents fees. Therefore, there's this idea that buyers agents are going to disappear. Josh, what are your thoughts on that? Do you have any thoughts on it?
Not super deep ones, but the whole case brings me back to this thought. Whenever I watch, say, be careful what you wish for. The devil that you know is easier to deal with than what you don't. I think there's this expectation that, hey, if we could make all realtors disappear, there's 6% there to divvy up between buyer and seller, because most people don't understand what realtors do. They don't understand the value of a good realtor. And many people have dealt with knucklehead realtors that shouldn't get 0.6%, much less 6%. So the industry could do a better job of regulating and policing itself, but the lawsuit's kind of silly. And if it is upheld on appeal and it does change things and we don't end up having buyer's agents, or there's not that dual commission structure, I think people will look back and go, hey, it wasn't as bad as what we thought.
There you go. Yeah, there's a lot up in the air at the moment, right? Like Josh said, countersuing. Does it go fully back to the case that was essentially just awarded, or is there somewhere, or does it go back to the way it was, or is there somewhere in the middle? I think there's probably somewhere in the middle. I think there's some give and take on both sides. Does it change? It absolutely changes. But like I said, with anything, buying a home is an emotional process. There's a lot that goes into it. Buyer's agents are not going to go away, in my opinion. But I will be the first to say the structure needed to change to some degree. The question is, how much is it going to change, and what does it look like? I think that's to be determined. I think we're months out from even knowing much of anything, to be completely honest. It's going to take some time to work it through. And with that said, you've now seen another 4 or 5 or 6 lawsuits in different states doing the same thing. So now everybody's jumping on the class action thing. It's not likely to be resolved anytime soon, in my opinion. I think it's something that's going to continue to kind of work its way through here, over the next couple of months to maybe longer, depending on what happens. All right, Josh, 5:59. I'm not going to touch that question. I'm not going to touch that question. All right. Let's see here.
You want to wrap it up with Jeff's question?
Jeff's question. Where's Jeff's question? Oh, is the idea of a starter home essentially dead because most recommend a longer term time horizon? No, a starter home, in my opinion, should never have been a 2 to 3 year home to begin with. Right? I mean, a starter home is just your first home. I think that's what you're starting with. That first home can be a 7-10 year deal, right? I mean, I don't know what the number is, Josh. Maybe you actually know this. What's the average number of homes someone owns in their lifetime? Do you have any idea what that is?
No, because average tenure is up over 10 years now.
11 years now, I
when
think. Yeah.
when I got in the business, it was like five for a first-time buyer, 7 for a subsequent buyer, and now everyone is up over 10, 11 years. So if you say that the median age of a first-time buyer is like 34, 35 right now, you're 46 before the median first move. So it's most people are only going to have 2 or 3 moves. I've only had 2. We bought our first place. We bought this one, and we had a plan that we had 1 more move in us. And I look and I go, I may not ever move. I might die in this house.
There you go. Yeah. So I think, you know, what you're perceiving as a starter home is probably maybe different than what I'm perceiving. I think it's relative to some extent. I don't think a starter home is a 2 to 3 year deal. I think a starter home is what you're starting with, and you know, for different people that can mean different things. I mean, my wife and I started together with this current home, and we lived in it 12 years. Right. And we've now just purchased another home, and I imagine we're probably going to be in that home at least 10 years. You know, just based on the age of where our kids are, and, you know, and our plan long term. I think the goal is probably closer to 15. But we'll see what happens, right? You never know. So, Josh, we're going to end it there. I want to thank all you guys for showing up here every week, asking questions, continuing to support the channel. It means a lot, and I am very grateful for that. If you haven't done so already, hit that thumbs up. Josh, parting words this evening.
We'll go back to Jeff's question where he says, is this essentially dead at the moment? He asked it twice. So the first is this idea essentially dead at the moment? At the moment is important, because what we see repeatedly in every industry and area, but especially in real estate and home ownership, people saying there's a new normal. You know, following 2008, we were told millennials were never going to buy homes. They bought later, about 4 or 5 years later than Gen Xers did, but they bought in equally higher amounts. So this idea that things are going to change massively over time, or that today is the way things are always going to be, that affordability will never correct, or that affordability will correct immediately with a massive crash, just question the assumptions and think that over a longer term time horizon, 5, 10, 15 years, what has been will likely continue to be, and it will change in subtle ways, not these massive overnight changes that make big headlines and make people want to click. So the people that are making content want to make these big outrageous statements. Things don't really change all that much. So if you're entering the market, it's, you know, affordability is strained. That idea of a starter home needing to be there a little longer, it's changed, but it's not gone. And things will normalize. Every time we get to these extremes, high and low, you can start to tell we're going to be trending back towards the middle.
All right, good stuff. I think that's a good place to end it. If you want to get in touch with Josh, or you need a lender anywhere in the United States, there's a link scrolling at the bottom there. Go to that. Happy to refer you to somebody we know, like, and trust that can guide you through that process. It'll also get you in touch with a real estate agent if you need a professional in any market out there. Happy to put you in touch with somebody I know. I have to go through my list and connect you and all that good stuff, but I'm happy to do it to make sure you're taken care of. That link will get you there as well. Lastly, we appreciate you being here. We appreciate the continued support. Until next week. Actually, it's next week's the day before Thanksgiving.
Kim is asking, next week is the day before Thanksgiving. Are we going to be here?
Yeah, we'll be here. All right.
Turkey legs in hand.
There you go. All right. Adios.
Amigos.